Welcome everybody to the latest in NCP's series of webinars. My name is Russ Lazaruk and I'm your host today. Joining me today are Richard Laterman and Rodrigo Gordillo from Resolve Asset Management. And just before we do get started, I'd just like to give you a quick disclaimer that everything that we talk about today is for education and entertainment purposes. It is not to be construed as investment advice. Obviously, we don't know your financial situation, so we're in no way can we give you advice over the internet. However, having said that, let's kick it off. And today it's going to be wide ranging. A bit of a focus on the traditional 60-40 portfolio, but how the investment landscape has changed. Inflation is back with a vengeance. And for investment advisors, investment professionals, and investors writ large, the landscape is shifting or appears to be shifting. So, but maybe Richard and Rodrigo, you can give us a quick intro to yourselves. We'll start with Richard, and then Rodrigo, and then we'll carry on from there.
Thanks, Russ. Thanks for having us. I'm a portfolio manager here at Resolve. I primarily handle communications with investors and would-be investors. I help steward them through the process of understanding how we invest and the suitability of our strategies for their portfolios. I'm also responsible for a lot of the writing that we do here in combination with Rodrigo and Adam. And I'm originally from Brazil. I was born and raised in Rio de Janeiro, and I've been in Canada for about 4 years. So most of my background had been in sell side and buy side for Brazilian equities. And I married a Canadian back in Brazil, and she wanted to move back. And as I was figuring out where I was going to work in Canada, I was told that my skill set was particularly well suited for one of the big banks or one of the big pension plans. And that's kind of what I was aiming for. But I was told to take a call with this Canadian group, Toronto-based quant fund, and I was like, okay, let's give this a try. And 5 years later, here I am. And even before I actually joined them, I became an investor because I was very taken with the ideas of diversification and systematic investing. But I think particularly because I had just lived through the 2014, 2016 period in Brazilian markets where we had a lot of political turmoil and very violent swings in the markets based on political gossip and things that are like hard to grasp when you live in North America and in more serious countries. And I was very ready to receive a new prism through which to see markets and to understand asset allocation processes, and the systematic approach resonated with me very well. So before I even joined Resolve, I became an investor and subsequently moved to Toronto and joined the team.
Welcome to Canada.
Isn't it amazing that he's got no accent whatsoever? He never lived outside of Brazil.
I know.
Good old American schools.
Yeah.
British.
Great job.
British schools, right? Yeah.
Yeah.
No accent though.
Yeah.
Good job.
Either way. Rodrigo, we've actually known each other for a number of years because we were at Macquarie together.
That's right.
I hate to think how long ago that was, though. It's almost 10 years now, you know?
Yeah, well, they left in 2014, I think. At least they announced at the tail end of 2014 that they were leaving Canada, right? So it's certainly before then.
Yeah.
Yeah, so my background is much like Richard. I'm Latin American. I'm born and raised in Lima, Peru. And I've told the story many times, but part of the reason that I invested the way I did from the get-go was because in 1989, inflation went to 7,200% in 6 months, and it created havoc in our savings and in the economy. That massive inflationary burst led to a massive deflationary bust in the next couple of years, as is the case when inflation rears its ugly head. And it forced our family to relocate to Toronto and build a new life here. And so for us Latin Americans, understanding the impacts of inflation, the idea that cash is trash in most circumstances and that no asset is safe was a key aspect of how I thought about markets. And it permeated my view on investing, whether I should focus on picking Microsoft versus Apple versus gold or German boons, right? Like it is,
Hmm.
it just opens up your perspective to a more global sphere. And my dad was a mathematician, so it was natural for me to gravitate towards rules-based investing. And so out of school, I worked at Manulife Financial and the John Hancock side of things, and quickly moved into a boutique wealth management firm for ultra high net worth Canadians. The minimum account size was 25 million, and I think we were at 2.5 billion at the time. It was like financial boot camp, just kind of learning how people with that amount of money think, and how to put portfolio managers together and asset classes together in interesting ways. But ultimately, I wanted to run money myself. And so I moved over to Blackmont Capital, which eventually became Macquarie,
Yeah.
to build the portfolios that I wanted. And so I gathered enough assets to run my models. And the models were basically a combination of equities, bonds, and commodities, and long short multi-asset strategies, that in order to make sure that what happened to my family then wasn't going to happen to my family again.
Yeah.
And so the all-terrain portfolio became the focus.
Yeah. Yeah. I think it is something that North Americans, probably going back several generations, have never really had to the degree that they have in Latin America, had to deal with hyperinflation. Um, we have had inflationary periods. I mean, I grew up during the 70s, early 80s. I remember having mortgages well into double digits. Um, but it has been a long time. I mean, Paul Volcker put a spike in inflation back in the early 80s. So we're now coming up to 40 years of really a disinflationary trend up until this point. But things are changing. So give me your take on what's going on now, and if you want to forecast, go ahead. I always say that we here at NCP are not forecasters. We try and assess probabilities and adjust accordingly, but we don't pretend to be able to forecast the future.
Let me start, Russ, by just setting the table of how the long-term dynamics between inflation and growth have looked like over not the last 10 years, but the last 100 plus years. Okay. Because I think let's you're right, move away from forecasting, but let's also be aware of how the machine works to be prepared for when these tides and inflation change, what impact it's going to have in our portfolio that has been favored over the last 40 years. And so this is a chart that I've been using since the beginning of my career. It basically maps the 60-40 portfolio from 1900 to 2016. I got to update it, I know. But it just continues in that disinflationary growth chart for the next 5 years. But this is in real terms, right? And what you notice here is, as you mentioned, Russ, 1981 was when Volcker broke the back of inflation. That was around here, right? And what this chart shows is it kind of separates the different regimes that we know the economy to go through over time. But unfortunately, in the last 40 years, from 1981 basically through to 2020, the lived experience of the average investor, the lived experience of the average advisor has been dominated by this regime of disinflationary growth. That is low inflation, abundant liquidity, and persistent positive growth. And in that environment, there is no better portfolio than an equity bond portfolio. There's no hedge fund that could beat it. And it is very easy. Put your sails up and you go. Of course, there was that period in the mid-noughts that everybody's forgotten about. And there was a little bit of inflation there that was straddled by two deflationary busts. But that 75% of your lived experience has told you that my instincts are that if I just stick to a low-cost 60-40 portfolio, I'm money. There's no issues with my future. But if we take a look prior to that, the previous 80 years, what you notice is that the disinflationary growth was the exception, not the rule, right? And in those periods where we had inflationary growth, deflationary bust, stagflation like in the 70s, if you just stuck to that traditional portfolio, you were in trouble. right? You need to fill in those gaps with things like commodities and things like the ability to go short, net short, things like equities, bonds, and commodities in order to be able to thrive, not just survive during those periods, right? So that's an important historical context where, the question we have to ask ourselves is, are we going to go back to that disinflationary growth environment where the market's really pricing in, inflation back at 2% in 18 months? Or are we going to see more of what we've seen in every other phase of history? That's really the question right now. And I guess, we're all about understanding how it all works and how to work on preparation rather than prediction, right?
And Rod, before you do move away from this chart, I just wanted to highlight, this is indeed one of my favorite charts. And the reason for that is this powerful blip that you see, that 9 years starting in 2000 all the way to 2009. In the industry, the jargon is, we call this path dependency. But you can think about someone that retired with this 60-40 portfolio in 1980. They were off to the races. They lived a very comfortable life, most likely. They were able to bequeath their family with some wealth at the end of their lives. But the same portfolio for the same retiree in 2000, that individual most likely had to rethink their life, maybe go back to work, because the first few years when they turned that key from accumulation to starting to draw from that portfolio was a 9 years of underperforming. So this is, I think, drives a point home of how you do not want to allow chance or the role of luck to influence your portfolio so dramatically. So going back to the issue of inflation now, and at the risk of jumping too far ahead into a prediction, and as I think Yogi Berra said, a prediction is very hard, especially about the future, right? But to talk a little bit about what's going on in inflation route, there's a few reasons why this is structural and may not be such a passing fad. There is this tendency for deglobalization that we've seen in the last several years, animosity among major global centers, particularly US and China, but also within Europe. And we see that the world that was built for efficiency and supply chains that were optimized to provide the lowest cost product at the quickest possible delivery. Now, a lot of these countries are faced with this prospect of important supply chains being delivered by geopolitical foes, and you do not want to depend on these people, and so you have to reshore the production back to your country. That means inflation, especially when you're dealing with labor costs that are much higher in places like Europe and the US. And the other point that I think is important to make is that we have been, for the last 40 years, in a strong push, if you think about a labor capital continuum, a strong push towards capital. And we're continuing to see that, we're starting to see that pendulum swing in favor of labor more recently, which is in itself quite inflationary. And then you have these geopolitical tensions that are starting to rise even further. So above and beyond just lack of cooperation, but actual, hot wars, we're seeing something more limited right now just within the European continent. But there's potential for other crises in this regard, and the availability of raw materials becomes a lot more uncertain in this type of environment.
Yeah, certainly, the geopolitical landscape has shifted immensely, triggered probably initially by COVID. I mean, it was changing. It changed once with the rise of China and the emerging markets becoming more industrialized. The whole globalization offshoring trend seemed to be well entrenched, and then of course COVID upset that, and we learned that just-in-time inventory management works great until it doesn't, and I think probably what we failed to build in was more resilience and redundancy within our systems, whether it was supply chains or in Europe's case right now, energy as well. I think your comments on labor and capital are really interesting, but do you think that labor is certainly getting more pricing power globally, and as we see workforces start to shrink. Even China has hit the point where their workforce is starting to shrink as well, giving labor more power. But with technology and automation, how much displacement do we see? So will that pricing power continue on?
Look, I think this question is one of yes and. I mean, there's no doubt that in our future we will see much more automation than what we're seeing today. There's no doubt that we have a large inventory of human bodies in organizations, every single organization that can be, with enough time and patience, replaced with automation. The issue is how long and when, right? When we're talking about investing, we're talking about the next 3 to 5 years,
Yeah.
maybe 10. And so the main focus right now is going to be on rebuilding old inventories, on rebuilding old supply chain, things that already exist but we can't use anymore, need to be replaced.
Yeah.
Right. And so that's not gonna be a shift to automation necessarily. It is going to require labor, and they are going to have purchasing power. We are seeing a push in labor costs because of it. And we are seeing a nation, many nations in decline in terms of demographics, right? So I think that the thing about the way that we think about investing, Russ, is one of, I don't know. Like, we need to have a kind of balanced portfolio to deal with maybe deflation, maybe inflation, maybe growth. But I think what the point of all of this is to make a case that it's not an insane proposition to say that the labor market has a high probability of being tight, that the supply chains have a high probability of being overwhelmed, that the fiscal spend that has come into the markets is pushing much more nominal demand than the current capacity of production exists in the world, and that we are going to have inflation longer and higher for longer, and we're going to have rates higher for longer, right? So in that environment, which is brand spanking new to the vast majority of investors, it's going to take a Herculean task of education to get people along, right? And if we're wrong, it doesn't mean that your portfolio goes down 50%. The beautiful thing about the way we think about balance is that if we're wrong, you're still okay. You're just not necessarily, just depending on that equity lever currently.
Yeah, because the starting point for us, the natural starting point, is of a place of humility, as Rodrigo pointed out, is of a place of saying, I don't know. And without having an active view, as a starting point, without having an active view on where asset classes are going, how would one build a portfolio that would be resilient across different kinds of regimes? And that is where sort of the natural starting point for us would be, which is obviously the risk parity portfolio and our take on how to deploy such a portfolio. But I just want to kind of close the loop on the labor, which is the fact that we have record low unemployment in the US with a record number or close to record number of unfilled posts.
Yeah,
I think screams something, especially when you figure the last 2 quarters have been contractionary, and now there's a debate of what defines a recession. Don't even want to go there because I think.
So what do you think that is, Richard?
Neither here nor there. Well, I think there is a lack of specialized labor to fill a lot of these posts. The Great Resignation, as it's been called, a lot of people that are technically still in the able-bodied workforce, right, the economically active age, have seen COVID as an opportunity to retire. I think there has been a shift in the zeitgeist with regards to stop optimizing for bank account and optimize a little bit more for quality of life. I think that has been a shift that we continue to see in multiple stratas of the demographics, particularly younger groups, but also people closer to retirement have just decided to anticipate their retirement. So you lack that skilled labor force, which is the portion of posts that I think lend themselves least to automation, right? It's probably the very end of the automation push is going to supplant these jobs. So it is a really interesting moment because you hear a lot of talking heads commenting on this and not quite sure what to make of it, because it seems like it's a quite unique situation with regards to the unemployment being so low, but economic activity palpably slowing down in multiple areas.
Yeah, although this shrinking of the labor force, we've known about it for decades because we've knew the size of the baby boomer cohort. We knew that when they were going to retire, they probably just retired 2 or 3 years early. So it's, yeah, maybe we've got something to blame ourselves for here.
The participation rate, the final point, being so low, I think also speaks to what you just said. We have very, very low, record low participation rate, which tells you that people have just decided to stop working or to stop participating formally in the employment force.
Yeah, which speaks again back to your point on labor and pricing power, and I would agree with Rodrigo's comments that in the 3 to 5, 7 year time horizon, technology is not going to replace all of those lost workers.
We're in a transition phase.
Yeah,
is where I would say we are, and in that transition phase, there's going to be a lot of air gaps in inflation and then deflation, because it's inflation because of all the things we discussed, but there will be a point where the Fed's going to win the war and create a disinflationary period that's going to hurt anybody who's long the inflation trade, right? So it's just going to be a bumpy road as we work through this middling area where its nominal growth may go up, but real rates might be negative. Your nominal growth going up because you're creating new jobs, you're creating new inventory, new infrastructure to replace the old one. But because of that friction, inflation is going to go up and real rates are going to be negative. So that's going to be an interesting, next few years in my view.
Yeah. So what you're saying is that along with market volatility, we'll have inflation volatility at the same time.
That's right.
That's right.
One probably driving the other. We started off talking about the 60/40 portfolio and how it's had, and you pointed out how it's had a great run. But I think for us in the industry, we understand how the interest rate environment affects the valuation of equities and bonds. But I think it's probably worth a quick 101 to the investing public out there that the discount rate that's used to value almost any asset class, including equities that we price every day, fixed income, but also real estate and everything else. In my mind, one of the real drivers of the run up in asset prices and very much put real estate in the same class here has been that fall in interest rates as that discount rate that we used to value them has changed.
Yeah, and you got to say what's the flip side of that, right?
Exactly.
So one of the things that people keep on pointing to me over and over again is how great the U.S. economy, how resilient the U.S. economy is being, and how companies are doing relatively well. What people fail to understand is that the real economy and the financial economy can be disconnected for a long period of time.
Yeah.
Right. So from 1966 to 1982, the real economy grew, I can't remember the exact number, but let's say it grew at 6-7%. Maybe that's a little high. It grew at a number. And the stock market from 66 to 82 annualized at around 0. And then from 82 to 97, the growth rate was the same as it was in the previous 12 years, but the stock market annualized at 16%, right? So this is all about multiples. And the multiples that we have given the equity markets right now and the bond markets as well has been driven by a reduction in interest rates, right? So the cheaper the money, the discount rate mechanism makes today's asset prices much higher. And what's happening today is we may see a decent real economy in the United States specifically, actually not necessarily in Europe, but in the United States specifically, while seeing multiples contract in the equity market back to normal historical norms, right? So if you're looking at a chiller PE ratio that's in the 26, 27 times for the US, the long-term average is around 15. And sadly, what tends to happen is that we don't go back to the average and stay there. We overshoot to the downside and then kind of recover back, right? So this is a very important point. Don't let the real economy tell you too much about what your stock portfolio is going to look like in any given year or, 3-5 year period. If we're in a rising rate environment, if we're in a tightening environment, if the if inflation is going to make things even tighter, if the fact that asset prices are not going up, they're going flat to down, all those things are the complete reverse of the previous 10 years. And hence one should expect a reduction in, or, coming back down from the stratosphere from the multiples perspective.
Yeah. Let me just add a couple points there. This idea of U.S. Treasuries, and particularly the 10-year, because it's got that mid duration that I think is representative of a lot of the duration of cash flows that most people use to price in their equities and real estate investments. So there's an absolute and a relative component to all this. The absolute is that interest rate becomes the discount rate from which we will build a discount rate for any investment, whether it's by using CAPM or any number of other metrics that one would use to create a discount rate. And so as that goes up, that denominator goes down. As interest rates go down, the quotient, right? The denominator goes down, the quotient goes up, and you have this multiples expansion and rise in the valuation of an equity or real estate. The other side of that is that relative game of asset allocation, and which has born this term TINA, right? We're in a TINA market. There is no alternative. And it is because in relative terms, as the large allocators looked to the bond market and saw no meat on the bone, there's nothing to be harvested there. They saw no alternative other than to push equity valuations higher and higher because they had nothing else to invest in, at least in their perspective. And so that is what has forced this multiples expansion to nosebleed highs that we see today.
Yeah, it's partly that, and it's probably just the math of the discount rate. When your interest rates are low, it inflates values because it's the future value of money.
Exactly.
That's right.
Yeah.
That's right. So there's no way that there isn't going to be any pain on the way down. And then when you hear, and we were hearing this from investors even last year, they were saying they're really concerned about bonds. Oh, we're really concerned about bonds. And they would explain their reasoning, and it was sound reasoning, and it was the same reason that we were all seeing. But it was a little shocking to see that they could not extrapolate that into the equity market, because the same reasoning applied.
Exactly.
So,
it's the same. Yeah.
The logic was the same. And so what we're seeing now is pain on both sides of that 60-40 so-called balanced portfolio. And a lot of people seem to be surprised by what's happening, but it just took the extension of that logic a little bit further into the asset class space to understand that the same concerns over bonds should have been placed in the equity market as well.
It's all discounted cash flows. So the traditional portfolio, the traditional structure is probably not going to work as well going forward. That means that we have to look further afield. We have to be diversified. Of course, we're trying to balance and look at various probabilities and scenarios. So what does that diversification look like in your mind?
Well, I think as Richard alluded to, you got to start with what we call the Hippocratic Oath of portfolios, right? First, do no harm. It's really hard to predict the future. It's really hard to know where asset prices are going to go, whether tomorrow it's going to be disinflationary, deflationary, inflationary growth, negative growth. It's a complicated, very complex and three-dimensional, 10-dimensional world. And so the do no harm portfolio is really, it goes all the way to the Talmud, right? And you can read literature that went back to, I think it was 300 AD, writings of saying if you want to invest your money, have a third in cash, a third in real estate, and a third in business, right? Just to kind of, because you never know what's going to happen to you. Harry Brown in the late 80s, creating the permanent portfolio is an easy, naive way of doing a quarter in cash, a quarter in equity, a quarter in bonds, and a quarter in gold. The more sophisticated the markets became, the more liquid and accessible certain asset classes globally became over the last 10 to 15 years, the better balance you could create. And so we really followed a lot of the work that Ray Dalio at Bridgewater has done, which is not only do you need diversity, and global diversity at that, so that's going to commodities, to equities, to bonds, to currencies, but you also need balance, right? Because you can't, the thing about the Harry Brown portfolio is that the volatility of equities are 2 to 3 times the volatility of bonds. So the equity, the tail is wagging the portfolio dog. And so the real innovation in the last decade or so in terms of portfolio construction from a do no harm approach is you do want to have equal risk for inflation, for bear markets and bull markets. You need to have an equal amount of risk from commodities for inflation, an equal amount of risk to equities, to global equities for growth, and an equal amount of risk to sovereign bonds for bear markets. And what I mean by risk is, I mean, if commodities are 3 times the risk of bonds, then I need to give commodities 3 times less money than bonds. And you can do the math, and you got to, those things change, the way the risks change, the correlations between these 3 major buckets change. You have to constantly monitor them and update your weights so that you remain in balance at all times without really caring what your dollar amounts are, right? And so as equities and bonds correlated in the beginning of this year, well, our risk parity goggles would have said, and have said, reduce your exposure to both bonds and equities and increase it to commodities. Okay, so that's step one. That's the minimum thing one needs to do if they feel they have no edge in seeing where asset classes are going to go in the future. Okay, so step two is recognizing that as professionals we may have an edge, right? There might be some knowledge and expertise that allows us to identify where markets may or may not be going in the future. And the missing piece with a global balanced portfolio like I just described is that there will be times where liquidity dries up and diversification will likely go away. And what that means is as the discount rate goes up, it does also affect commodities, right? And commodity cash flowing companies. And so they will have moments of these air gaps where the only solution is to be able to short those markets, right? So our methodologies, our strategies throughout the year have been long all commodities. We've been short a bunch of commodities. Copper, palladium, platinum made us a lot of money in the beginning of the year by being long. Copper, palladium, platinum made us a lot of money in the latter half of the year by being short. We've been long bonds, short bonds, and long bonds again. And so that extra level of diversity, the ability to protect from the downside, is the last missing piece, right? And I don't mean long short equities. Those tend to have their own place in a portfolio where it's about dampening volatility for equity portfolios most of the time. This is really about having the ability to go net long, net short, and net neutral if you need to, all of these commodities, equities, bonds, and currencies to maximize your opportunity for diversification and protection. Right. So that's really the last missing piece. The last piece are those very rare but very impactful periods of abrupt pandemic. Markets are down 15% in a couple of weeks. Right. And those are truly like they're sentiment shocks that that's the moment that cash goes from being trash to being king.
Yeah.
Right. But there's another element that you can add to that, which is we have these the ability to go long volatility nowadays, right? Whether you're doing it through options or you're doing it through direct VIX contracts in the future space, you have the ability to offset a lot of those losses. So that is the third level of protection, kind of the parachute that comes in, almost like I'm mixing metaphors here. Parachute, special forces coming in, rarely needed, but when they're there, they're impactful and they're in and they're out, right? So those are the 3 layers: balanced portfolio, ability to go long and short for prolonged multi-year bear markets and prolonged multi-year inflationary regimes, and then the special forces, long volatility when sentiment just dries up, like in October of 2008, like in 2020.
Yeah, so diversification, not just by asset class, but by being
Regimes.
long short regimes. Yeah,
economic regimes.
Yeah.
I would say so. There's this structural core, strategic allocations to global asset classes in a manner such that you get equal risk contribution from each component of the portfolio, and allow each component to deliver its own unique characteristics to the portfolio. I think that's really the essence of what risk parity is trying to do, is trying to give each component their say. Everybody has a say. No one contributes more than the other. And so you start from there. The second aspect of this, what Rodrigo was describing, is the ability to tilt tactically and go long and short and neutralize a natural long position, bring it all the way down to zero, maybe even go short or augment that position farther long, depending on different signals and depending on strategies. We can get to that, the specifics of that perhaps later on. But it's this ability to shift tactically. And then the third piston would be that long volatility component that helps us mine liquidity gaps.
Yeah. So investing in our world, and I know that very much so. So in your world, is always an iterative process. And we start off with a thesis, and we test it, and then we try it, and we twist and change. And can you maybe give a bit of background how your thinking changed over time, or your methodologies, and how's technology, machine learning, things like that played into it, and in later years?
Yeah, those are very good questions. And I think, one of the things that I feel I had a head start on than most people in the markets was that recognition that I wasn't shackled to a domestic stock bond portfolio, which a lot of people were in the beginning of my career, right? That's the only way to invest. You're in the markets, what stock are you picking, right?
Yep.
For me, coming from Peru, I had the world was my oyster, right? So from the perspective of, okay, I have all this liquidity. I can buy Europe, I can buy Latin America, I can buy gold, commodities. I mean, certainly by the time I got into the business in '04, already I could get exposures that didn't exist 10 years before that. So from a technological perspective, when I started using exchange traded funds, I had access to commodities. I had access to global equities through via ETFs. I had access to gold and sovereign bonds, right? So already I had a leg up in this global view and the tools to diversify. So I can understand why many didn't use it, because they were brand new tools and they were domestically focused. So that is an important kind of worldview with the tools. Then you start putting the tools together from a Harry Brown portfolio where you say diversity, that's all I need. And then you realize, oh my God, I had a big deflationary bust in my portfolio, got into big trouble because, oh yeah, the volatility commodities are 30% and bonds are 5%. Bonds did go up, but they went up like this and commodities went down like this. How did I get that one wrong? How do I create that balance? So the next step was in recognition that you don't want a 3-piston motor to have different size pistons. You want those pistons to be in balance, right?
Yeah.
And in the beginning of my thought process, I had the big equity piston, even bigger commodity piston, and a tiny little bond piston, right? From the risk perspective.
Yeah.
So moving away from dollar-based equity equality to risk-based equality was a massive thought process, like a leap in thought in portfolio construction. I've always been from the get-go a fan of shorting, right? And that came from, again, at the time in Canada, there was one, maybe two managers that you could allocate to that had the ability to go long and short. AHL diversified by, I think it was AHL Canada that is now next.
Yes.
But they kind of left, they stopped offering that. And so, the ability to go long and short, full long and short, all these asset classes was an important accessibility issue that didn't exist really in Canada for a while. And then once, you get into this and you start realizing, okay, from a base perspective, like we have hit all the basics, right? Equal risk contribution, being able to go long and short. And then you start saying, okay, well, what else can I do here that my puny little human brain that has put all this stuff in an Excel isn't seeing, right? You'd ask all these questions. Well, what would happen if this environment comes? Oh, well, that environment did exist between 76 and 79. Okay, but I've created this system that just averages out 50 years, 70 years of information. What if I'm able to kind of apply some data science techniques that is able to splice up the different regimes and identify models that might work in this specific regime versus another specific regime, where instead of averaging out all regimes, I'm really focusing on one at a time and allowing those systems to be part of our methodology in a way that if it identifies, oh, it looks like 76, 78, we have a model for that. Let's put it to work, right? So that's kind of the evolution of like just broad-based. I want to be broadly correct rather than specifically wrong, because I'm afraid of being specifically wrong. So I want to average out all my signals in all the regimes to recognizing that there's value in being a bit more specific, but not so specific you blow up, just specific enough where you're capturing more signal than noise, right? So I think machine learning can be seen as something esoteric and wild and new, but the reality is that a lot of this came from my father's research in operations research that he in his master's in Monterey, California, right? It's about extracting signal from noise in thoughtful ways, right? So that's kind of, and that part I give to my quant team, Andrew Butler, who's our CIO now. He just today got his PhD, passed
just defended his thesis.
He defended his thesis successfully.
Congratulations
and
to him.
For us, it was, hey, can we do better? Hey, Andrew and team, go ahead and make it better. And I'm lucky enough to have had these amazing employees and partners that can really add to this diversification. But look, just saying all that, we haven't doubled or tripled the return of the portfolio. All the things, the basic theories that we just discussed are 90% of the battle. Like, you don't have to go that extra step. I think most people will get, it's a Pareto principle, right? Just by being diversified, just by thinking about long short, even if it's a moderate, a simple long short manager, you are in better shape. You're going to go from 0 to 80 with those simple steps. And then all we're trying to do as professional money managers is earn our fee. And we do that by continuing to work the problem.
I'll just add a couple of points here. I think Rodrigo's earlier comment about coming from Peru and having this global view and vantage point from asset allocation perspective, I think it's hard to overstate that one. I had the same experience. When you're born outside of the core of the financial world, you learn very quickly how weak your currency is, how volatile your political system can be, whether it's through revolutions or whether it's through just gridlock. And you understand that if you want to protect your family's wealth, you have to own hard currency. That is the dollar, the Canadian dollar. Even though I've spoken to a lot of Canadians, they don't seem to put the Canadian dollar on par with the major G7 countries, but I would definitely beg to differ. So having this vantage point of investing in strong, in assets that are backed by strong currencies, I think cannot be overstated, and I think is a huge component. And I would just add, sort of from my perspective, joining Resolve and seeing the evolution, one of the first things that I was taken by was this idea of, again, being humble about what we know and what we can know and what we can't know, an explicit recognition of this concept that I think was coined by George Soros, but it's this idea that I think we all kind of have come to understand, that markets are by no means efficient, and there's lots of reflexivity in markets. And so what you want to do when you're trying to harvest an edge systematically is recognize the anomaly, understand how sustainable that anomaly may be over time, but then go out of your way to be not deterministic about the way that you harvest an anomaly. So to use an example of trend or momentum investing, the anomaly that you're trying to capture there is herding behavior. It's this idea that we will herd until the machines take over. This is just human nature. And on the way up, it feels like, FOMO takes over and you don't want to invest in anything else. And then on the way down, the door could not be wide enough and everybody wants out. So if you want to harvest that anomaly, sure, the 200-day moving average is a fine way to do it, but could you use the 187th day? Or could you use 262 days? And that's just to stay in the moving average arena. How about the shape and slope of a curve, or the number of days an asset has been above a certain trend, or once asset classes are they ranked in absolute returns or in risk-adjusted returns? So you can change the specifications of trend or momentum, or any number of the anomalies that we trade. You can change the lookbacks that we use, or the forecasting horizons that we're trying to attain. At the end of the day, be avoiding overly specific definitions of these anomalies, I think, is an edge unto itself. Now, there's a flip side to that, which is once you're this diversified, asset classes, strategies, the specifications within strategies, by definition, you are underperforming the best market and the best strategy on any given year. And a lot of, I think humans like the opportunity to have lottery ticket size wins and the opportunity to make such windfall gains. And people will want to chase those returns, but ultimately long-term successful investing has much less to do with hitting home runs and much more to do with avoiding huge drawdowns that last multi-years. So ultimately our objective is to try and avoid the length, the duration, and the intensity of the drawdown, and compound the portfolio positively as often as possible. Those, I think, are the two North Stars, if you can use two North Stars to navigate at the same time.
Yeah.
But I think they are correlated in a lot of ways. Those are, I think, the two driving principles that we strive for in trying to create balance in the way that we manage money and focusing on the long term.
Yeah, it's interesting. Just picking up on that a little bit, and people do like to win the lottery and hit the home runs, but in reality, I think, in my experience, and maybe it's a North American thing, just get me the returns that I need to reach my goals. And I guess to plug our own shop a little bit, I mean, we're very much believers in goals-based asset allocation and goals-based planning. So each goal has its own bucket. And if that's 100% must achieve, can't lose any money, then it has its own allocation, as opposed to the aspirational goal that may be a bequest to a charity in 30 or 40 years. I mean, they're very different, but each and we built off the work of Brunel, and I think it works well. It gives it's very intuitive for the investor, for the client, that okay, I know that each one of those goals is taken, but it fits in the same thing as, we're not there to shoot out the lights. We're not there to get you the absolute best return at whatever the asset class is, or the specific stock. We're there to help you achieve your goals with the lowest amount of risk possible.
Amen.
Yeah.
Yep.
Yeah. Good. Which I think is probably a good place to wind it up. Any closing thoughts?
No, I think, this is going to be a time that's going to be uncomfortable for a lot of people, because their natural instincts and many years of experience are going to tell them that the correct options are going to be wrong. And so I think it's a time where people need to separate experience from expertise. Experience is what you live through. Expertise is the professional that understands the world as it operates over long periods of time. And we need to lean more on expertise in the coming decades as this world figures itself out, in my opinion. So if we can do that, if we can kind of lean on experts again in a world where people think that's DIY and raise the sales and you're going to be fine, I think we'll be in good shape.
Look through the windscreen. Don't drive looking in the rearview mirror.
Exactly right.
I would second that and add that systematic investing, which is primarily what we do, helps investors steer away from the pitfalls that their emotions can put them in, and chasing returns, but also chasing narrative. One of the things that I have kind of had a sense, but really internalized after joining Resolve, is this idea that price doesn't chase narrative. Narrative chases price.
Yep.
Price dynamics occur, and then newspaper and journalists are reaching out to fund managers to try and make sense of what happens, so that the headlines the next day can make some sense of what's going on.
Yeah.
I have seen our systems act in ways that seemed initially so counterintuitive and so nonsensical, and then eventually see them vindicated, and that they were just ahead of where the narrative was at.
Yeah.
And I was just, so my only point here is that thinking in terms of systematic approaches to investing, keeping your emotions from getting in the way, I think can be a particularly useful tool in this moment in time, because as uncertainty rises and inflation continues to affect cost of living, and people's level of comfort starts to lower and lower, there's a tendency for people to try and make heroic moves, or try and guess what's happening. And I think sticking to a process and being disciplined about that process, and understanding what you can and cannot measure and know ahead of time, I think that's a useful recipe to avoid large drawdowns, and to keep your portfolio safe.
Great. Well, thanks again, guys. For our audience out there, if you want to hear more from Rodrigo and Richard and their team, you can tune into their podcasts at Gestalt U.
Yeah. I think that Gestalt University on any podcast player, and also known as Resolve Riffs on YouTube.
Yep.
Every Friday. We started up again this Friday. Will be our first day back after the summer break.
Congratulations. Well,
thanks for
thanks
having
again.
us, Russ.
Thank you, guys, and really appreciate your time.
Appreciate it, Russ.
Okay. Thanks, guys.